2. Term life insurance. A client can transfer his risk of death to a life insurance company by purchasing a life insurance policy. There are several types of life insurance, including term life, term, 100, whole life and universal life insurance, and the marketplace offers many variations of each type. Life insurance agents must identify the best type of insurance for each client based on their unique needs. This chapter explores term life insurance, which is the simplest form of life insurance available. 2.1 What term means. Term life insurance is a contract that specifies that, in exchange for a premium, the life insurance company promises to pay a death benefit if the life insured dies within the fixed term of the contract. The term is the period of time during which the coverage is guaranteed to remain in place, as long as the policy's premiums are paid. 2.1.1 Typical terms. The most common terms for life insurance are 1 year, 5 years, 10 years or 20 years, or to a specific age, example, to age 60. However, other terms, such as 3 years, 15 years or 30 years, may also be available, depending on the insurance provider. 2.1.2 Age limits. Most insurance companies will not provide term insurance coverage past a specific age, often around age 75 or 80, simply because the risk of having to make a payout is too great. This means that they will stop issuing new policies at about age 65 or age 70, depending on the policy's term. When insurance is provided to older ages, the premiums are very expensive. 2.2 Policyholder versus life/lives insured. The policyholder is the person who purchases the life insurance contract, or who later acquires ownership of it via gift or assignment. The policyholder is responsible for making all decisions regarding the contract, including naming the beneficiary of the policy, paying the premiums, canceling the policy, or assigning the policy to another individual. The life insured is the person on whose life the insurance contract is based. If the life insured dies during the term of the life insurance policy, then the life insurance company must pay the death benefit. Some insurance products may also refer to the life insured as the annuitant. The policyholder can also be the life insured, but this does not have to be the case. Life Insurance Chapter 2 Term Life Insurance 11. Example. Sandra would like to leave a legacy to her adult son, Tristan, when she dies, so she bought a $300,000 10-year term life insurance policy on her own life, with Tristan named as the beneficiary. Sandra is both the policyholder and the life insured. Sandra works for ABC Limited, and she is very important to the success of the business. ABC Limited bought a life insurance policy on Sandra's life. ABC Limited named itself as the beneficiary, and they plan to use the death benefit to help them recruit and train a replacement if Sandra dies. In this case, Sandra is the life insured, but ABC Limited is both the policyholder and the beneficiary. Sometimes the policyholder is referred to as the insured, which is not the same thing as the life insured. A policyholder is referred to as the insured because he bought protection from the financial loss that would otherwise result if the life insured dies. 2.2.1 Single life. Most term insurance policies are single life policies, meaning that only one person is insured, and the death benefit will only be paid if that person dies within the term of the policy. 2.2.2 Joint first to die. While most life insurance policies are single life policies, there are two types of life insurance policies that are based on the lives of two or more people. With a joint first to die life insurance policy, a single amount of coverage is placed on two or more lives insured, and the death benefit is paid out upon the death of the first person to die. Joint first to die life insurance coverage might be appropriate whenever two or more people share a debt obligation. Example. Sue and Cindy are common law partners and they recently bought a house together, with an outstanding mortgage of $250,000. While they can comfortably manage the mortgage payments with their combined incomes, if one of them were to die, the survivor would have a hard time making those mortgage payments. To ensure that the survivor would be able to keep the house, Sue and Cindy took out a $250,000 10-year term joint first-to-die policy, naming the survivor as the beneficiary. So if Sue dies, Cindy will receive the death benefit and can pay off the mortgage and vice versa. Joint first-to-die life insurance coverage is also often used to fund business buy-sell agreements, as discussed further in Chapter 8 Business Life Insurance. Joint first-to-die contracts usually terminate upon the death of the first person to die. However, some contracts give the surviving life insured the choice of continuing the same level of coverage on their own life under a new policy, without having to provide proof of insurability. 6 This can be particularly advantageous if the survivor's health has deteriorated to the extent that he would otherwise find it difficult to obtain insurance. Usually, this option must be exercised within a certain time after the first death, example, 30 days. Example, Cont. For years after Sue and Cindy bought their joint first-to-die policy, Sue was killed in a car accident, and Cindy received the $250,000 death benefit. Cindy and Sue adopted a baby 2 years before Sue's death, and Cindy wants to make sure the baby is provided for if she dies. For health reasons, Cindy might find it difficult to buy life insurance with reasonable premiums. Luckily, their joint first-to-die policy gives Cindy the option of continuing coverage of $250,000, as long as she exercises the option within 30 days of Sue's death. A joint first-to-die life insurance policy on 2 lives is typically less expensive than 2 separate life insurance policies of the same coverage amount on each life individually. This is because the insurance company only assumes the risk of paying out one death benefit under the joint policy, while it risks having to pay out 2 benefits if 2 separate policies are purchased. Joint life insurance should not be confused with combined insurance, which is a marketing concept. Some insurance companies allow 2 individual policies to be purchased under a single insurance contract. The advantage is that only a single administration fee is charged, and a small discount on the premiums may also apply. A combined insurance contract will pay out 2 separate death benefits if the lives insured die at the same time during the term of the contract. If only one of the lives insured dies, the coverage will continue for the other life insured at single-person rates. 2.2.3 Joint Last-to-Die. With a joint last-to-die life insurance policy, a single amount of coverage is placed on 2 or more lives insured, and the death benefit is paid out upon the death of the last person to die. Joint last-to-die life insurance policies are most appropriate when the risk being insured against does not arise until the death of the last person covered by the policy. One such risk is the tax liability that can arise upon the death of the second spouse. When a person dies, he is deemed to have disposed of all of his capital property for its fair market value just before he died, and this can result in a significant taxable capital gain for his estate. An exception to this rule occurs if the property passes to his spouse or common-law partner. In this case, there is no deemed disposition of the property until the spouse disposes of the property or dies, which is when the large tax bill can arise. Couples therefore often use joint last-to-die life insurance to pay the tax bill on the death of the second spouse, particularly with respect to property such as a cottage or a business that they want to pass on intact to their children. Example: Hamish and Elizabeth, both aged 55, bought a cottage 20 years ago, and it has appreciated significantly in value. They would like the cottage to pass to their children when they die, but they are worried about the income tax liability at death, which their accountant has advised them could be more than $100,000. If Hamish dies first, his share will go to Elizabeth, and it will not trigger a capital gain because of the spousal rollover rules. However, when Elizabeth dies after him, a joint last-to-die insurance policy would ensure that the estate has enough money to pay this tax bill. However, because term life insurance is usually not available past age 65 or 70, except at great cost, joint last-to-die life term insurance policies more commonly take the form of permanent life insurance policies. 2.3 Death Benefit. The death benefit is the amount that the insurance company will pay if the life insured dies while the policy is in force. Term insurance policies are purchased for an initial amount of coverage, which is called the face amount. However, the death benefit of a term insurance policy may increase or decrease over time, depending on the type of policy, as shown in diagram 2.1. 2.3.1 Level term. The majority of term life insurance policies offer a level death benefit, meaning that the death benefit equals the initial face amount, regardless of when the life insured dies during the term of coverage. A level death benefit is most appropriate when the insurance need is not expected to change significantly over the term of the contract. Example: Brad borrowed $100,000 from his father, Stephen, to start a new business. Brad promised to pay it off in a lump sum in 5 years, when Stephen plans to retire. Knowing that his father needs the money to be able to retire, Brad wants to make sure that he can repay the loan, even if he dies. Brad purchased a 5-year term policy with a level death benefit of $100,000. Many people who buy term life insurance often ignore the fact that their needs might change over the term of the policy. They buy a policy with a level death benefit because it is simple, what they are most familiar with, and most often promoted. However, this means they may be underinsured or overinsured at some point during the term. Term 2.3.2 Decreasing term. Decreasing term insurance provides a death benefit that decreases over the course of the term, while the premium remains level. The premium on a decreasing term policy with an initial face amount of $100,000 should be less than the premium on a $100,000 level term policy. This reflects the fact that the amount at risk for a decreasing term policy declines over time. Decreasing term insurance is most often used by people who have mortgages, because the amount at risk, i.e., the outstanding mortgage, decreases over time. In fact, banks commonly encourage their mortgage customers to buy mortgage insurance, which essentially is decreasing term insurance, sold as group insurance by a company affiliated with the bank. Example: Ranjit and Alicia bought their first home in 2011 with a $200,000 mortgage amortized over 25 years. They bought a joint first-to-die $200,000 25-year decreasing term insurance policy to ensure that if one of them died, the other would be able to pay off the mortgage. Few insurance companies currently offer decreasing term insurance for individuals. As noted above, it is mainly offered on a group basis. 2.3.3 Increasing term. Increasing term insurance provides a death benefit that increases over the course of the term. The increase in the death benefit is usually applied at predetermined times, such as annually or every 5 years. The increase in the death benefit can take the form of a fixed dollar amount, example, $50,000 every 5th year, or a fixed percentage, example, 5% annually. Less commonly, it can also be tied to inflation, example, increased annually by the Consumer Price Index, CPI. The premiums for an increasing term policy usually increase at the same time as the death benefit increases, and by a proportionate amount. For example, if the death benefit increased by $10,000 on an initial $100,000 policy, the premium would also increase by 10%. Increases in the death benefit are usually restricted, either by a cap on the maximum death benefit, example, 150% of the original face amount, or a cap on the number of increases, example, every year for 10 years. Increasing term insurance has become increasingly difficult to find in Canada, but it is still offered in the United States. In Canada, the same effect may be achieved by adding a rider to the policy. Riders are discussed in Chapter 5 Riders and Supplementary Benefits. Increasing term insurance is useful in situations where the amount at risk is expected to increase over time, perhaps due to inflation, investment returns, or salary increases. Example: Connor is a business executive who is driven to succeed, and he expects his income to continue to increase at about 10% per year. If he dies, he would like to ensure that his wife receives a lump sum that equals 10 times his annual salary. Connor could buy increasing term insurance with an indexing factor of 10%, with an initial face amount equal to 10 times his current salary. One of the benefits of increasing term insurance is that the coverage increases even if the life insured experiences a decline in his health. The death benefit will continue to increase, up to the cap specified by the policy, as long as the policyholder pays the increased premiums, and the premium increases are known in advance. 2.4 Term insurance premiums. A premium on a term life insurance policy is the amount the policyholder pays to the insurance company in exchange for the company's promise to pay the death benefit if the life insured dies during the term covered by the policy. With the exception of increasing term insurance premiums are typically level over the term. The policyholder usually has the option of paying them monthly or annually, by check or by pre-authorized direct payment from a bank account. Provinces and territories charge a premium tax ranging from 2% to 5% on life insurance premiums charged by licensed insurers. This premium tax is incorporated into the premiums charged to the policyholder. For example, if a policyholder pays a premium of $102 in a province that has a 2% premium tax, the insurance company must remit $2 of that premium to the provincial government. 2.4.1 How premiums are set. Term life insurance is pure insurance, meaning that its value relates solely to the benefit that is paid out upon death. The premiums are simply a combination of the mortality costs experienced by the insurance company and the expenses, including the company's profits, incurred in providing that insurance. 2.4.1.1 Mortality costs. Mortality costs approximate the insurance company's cost of paying out policy death benefits. On a per-policy basis, the annual mortality cost is estimated by multiplying the policy's face amount by the life insured's probability of death during the year. The insured's probability of death depends on many factors, including age, gender, and health status. During the underwriting process, the life insurance company tries to estimate the life insured's probability of death by classifying him in a group of similar people with known mortality experience. 2.4.1.2 Expenses. Premiums also have to cover the insurance company's expenses, including the cost of selling the policy, example, marketing, salaries or commissions to agents, underwriting the policy, example, processing applications, undertaking medical exams, issuing and administering the policy, investigating claims, paying death benefits and the profits sought by shareholders. If the insurance company invests the premiums, the resulting investment income may be used to offset the expenses. 2.4.2 Sample premiums. Table 2.1 shows sample annual premiums for 10, 20, and 30-year term life insurance coverage on a male non-smoker in excellent health with a $100,000 death benefit. The figures given include the annual policy fee, which covers administrative expenses. Notice how the premiums do not change very much between ages 20 to 35 for the 10-year term, but they start increasing significantly at about age 40, with very dramatic increases from age 55 onwards. This suggests that clients who opt for term life insurance should purchase it sooner rather than later. Also, the annual premium does not vary significantly between the 10-year and 20-year terms until about age 35, making the longer term more attractive for younger clients. 2.5 Renewable versus non-renewable term insurance. Term life insurance can be either renewable or non-renewable. With a renewable term insurance policy, the policyholder is guaranteed the right to renew the policy at the end of the term for another term, without having to provide proof of insurability at the time of renewal. The right to renew is usually limited to a specific age, example, to age 70. With a non-renewable term insurance policy, the policy expires at the end of the term, and the policyholder has to apply for new life insurance if he requires continued coverage. If the health of the life insured has deteriorated, the policyholder risks higher premiums or even being denied coverage. Henry bought a $200,000 5-year renewable term life insurance policy on his own life when he was 30 years old. Because of his great health at the time, he got the best rates possible. When he turned 35, he renewed the policy and his premiums increased to reflect his age, as specified by his original contract. When he was 38, Henry was diagnosed with cancer. When Henry turned 40, he renewed the policy for another 5-year term, and again the premiums increased, but only to recognize his increased age at the time of renewal. His cancer diagnosis did not impact his premiums, and he could not be denied continued coverage. Renewable policies are more expensive than non-renewable policies. With a renewable policy, the insurance company is taking the added risk that they may have to continue coverage on the life insured after the end of the term, even if his health has declined. 2.5.1 Renewal Provisions. The premiums upon renewal may vary, depending upon the policy provisions. 2.5.1.1 Renewable with guaranteed rates. While the policyholder of a renewable policy is guaranteed the right to renew the policy at the end of the term, the new premiums will reflect the age of the life insured at renewal. Most policies provide a guaranteed schedule of renewal rates when the policy is first issued. Example: Prina purchased a 5-year renewable term life insurance policy when she was 25, with premiums of $155 per year. Her policy offers the following guaranteed rates upon renewal. So Prina can rest assured that she can maintain her insurance coverage until age 65, as long as she is willing to pay the increased premiums upon renewal. 2.5.1.2 Re-entry term with adjustable rates. Some insurance companies offer re-entry insurance, which essentially is a renewable policy that can be subject to 2 different renewal rate schedules, a guaranteed renewal rate, and a lower rate that is adjusted for the good health of the life insured. The life insurance company will reassess the health of the life insured at the time of renewal. If he is in great health, he will qualify for lower premiums on renewal. If his health has deteriorated, he still has the right to renew the policy, but the guaranteed renewal rates are higher than those for a renewable policy that does not have the re-entry provision. The advantage of a renewable policy with a re-entry provision is that the initial premium tends to be lower, so the policyholder can save money in the early years of the policy. This is because the policyholder is retaining a portion of the risk. The insurance company is assuming less risk by requiring those with decreasing health to accept the higher guaranteed renewal premiums if they want to maintain their coverage. Re-entry policies may be a good deal if coverage is only required for a term or 2, or if the life insured has reason to expect continued good health, perhaps due to his family's excellent health history. If the policyholder thinks he may want to renew the policy beyond that timeframe, he would assume less risk by purchasing a regular renewable term insurance policy. 2.6 Convertible Term Insurance. Convertible term insurance gives the policyholder the option of converting the term policy to some form of permanent life insurance, i.e., whole life, term, 100 or universal life insurance, at some future date. The conversion does not require proof of continued insurability, so the policyholder can acquire lifetime protection even if the life insured is no longer insurable. Example: Anya has learned that a rare medical condition runs in her family. The condition usually doesn't develop until after the person reaches 30 years of age. Anya is not afflicted, but her teenage daughter, Jeanette, has a 25% chance of developing the condition. Anya is worried that this may prevent Jeanette from being able to buy life insurance when she is older. She bought a $200,000 renewable and convertible term policy on Jeanette's life, and she plans to assign, i.e., transfer ownership, of that policy to Jeanette when she is an adult. If Jeanette does develop the condition, she will still be able to convert the policy to a $200,000 whole life policy, giving her access to lifetime insurance protection. Convertible term insurance is more expensive than term insurance that does not include a conversion option, because it exposes the insurance company to additional risk beyond the original term. In fact, the people who are most likely to convert the policy are those who have experienced a decline in their health, which would make a new life insurance policy too expensive or even impossible to get. The insurance company may also restrict the age at which conversion is permitted. 2.6.1 Incontestability and suicide provisions. The new policy issued as a result of the conversion is usually treated as an extension of the original policy for contractual purposes. This means that the clock is not reset for the purposes of applying important legal provisions, such as the incontestability limitation and suicide limitation. Under the mandatory incontestability limitation, an insurance company only has 2 years after it issues the policy to void the policy if it discovers an error in a material fact in the application. A material fact is any piece of information that would have influenced the insurance company's decision about providing the insurance coverage, example, smoking status, known health issues, age, had it known about it during the underwriting process. This 2-year period is called the contestability period. Once the contestability period has passed, the policy becomes incontestable, and the insurance company can only void the policy if it can prove that the policyholder committed fraud when applying for the policy. When Marie filled out her insurance application, she answered no to the question about having a heart condition. However, a few years ago, Marie went to the emergency room complaining of chest pains. The diagnosis was inconclusive, and Marie never followed up with the recommended heart specialist, so she didn't think she needed to mention it. If the insurance company discovers this fact within the first 2 years of the policy, it will have the option of voiding the policy. However, once the contestability period has passed, they cannot cancel the policy. Insurance contracts also usually include a suicide exclusion clause, which states that the insurance company will not pay the death benefit if the life insured dies by suicide within a specified period of time, typically 2 years, after the contract was issued. If the life insured dies by suicide after the suicide exclusion period ends, the insurance company will pay the death benefit. By exercising the conversion option of a convertible term life insurance policy, the policyholder acquires a permanent policy without being subject to a new 2-year contestability period or suicide exclusion period. 2.6.2 Attained age versus original age conversions. Attained age is the age on which the life insurance premiums are based. Depending on the administrative policy of the insurance company, attained age may be considered to be the age of the life insured as of his last birthday, his next birthday, or his nearest birthday. Example: Manuel bought a term life insurance policy on August 12, 2021. His date of birth is November 1, 1987. His premiums will be based on black small square age 33, if attained age is based on his last birthday. Black small square age 34, if attained age is based on his nearest birthday. Black small square age 34, if attained age is based on his next birthday. Depending on the convertible policy, the premiums for permanent life insurance upon conversion may be based on the attained age of the life insured at the time of the conversion to the permanent policy. This is called an attained age conversion. Some policies base the permanent life insurance premiums on the original age of the life insured at the time the insurance contract was first issued. This is called an original age conversion or a retroactive conversion. Retroactive conversion. Example: Patrick was born on June 1, 1967. His insurance company uses the nearest birthday when determining attained age. He bought a $500,000 5-year renewable and convertible term insurance policy on September 15, 2012, when his attained age was 45. The policy permits conversions at any time up to age 65. Patrick renewed the policy in 2017, and he decided to convert the policy on May 10, 2021. If this is an original age conversion, his permanent life insurance premiums will be based on age 45. If this is an attained age conversion, his permanent life insurance premiums will be based on age 54, because his attained age on May 10, 2021, is based on his nearest birthday, which would be June 1, 2021. Original age conversions would result in lower premiums for the permanent life insurance, which would appear to be advantageous. However, the initial premiums for an original age convertible term policy will be higher than the premiums for an attained age convertible term policy. This is because the insurance company is taking on the risk of providing lifetime coverage at a lower rate if the original age conversion is exercised. Furthermore, in the case of an original age conversion, the policyholder would have to pay the insurer a lump sum equal to catch-up. For some policies, the lump sum is equal to the cash value that would have accumulated if the policyholder had chosen the permanent insurance policy from the beginning. Other policies require the policyholder to pay a lump sum that is equal to the difference in the premiums he actually paid, and the premiums he would have paid had he started with the permanent insurance from the beginning. Regardless of the method used, the lump sum can be substantial, and for this reason most insurers either do not offer original age convertible policies, or they require the conversion to take place within the first 5 or 10 years after the policyholder bought the convertible policy. 2.7 Advantages and disadvantages of term life insurance. The advantages and disadvantages of term life insurance are summarized in Table 2.2. Table 2.2. Advantages and disadvantages of term life insurance. Advantages, disadvantages. Black small square low initial cost. In the early years of the policy, the premiums for term insurance will be lower than those for permanent insurance, making it affordable for those who cannot afford permanent insurance. Black small square premiums are guaranteed over the term. Black small square renewable and convertible provisions can be used to extend coverage. Black small square term of coverage can be customized to meet a specific need. Black small square premiums and coverage are not guaranteed beyond the term or renewal period. Black small square premiums increase as the life insured ages and can become prohibitive. Black small square coverage is usually not available past a certain age. Black small square policy is worthless at the end of the term. 2.8 Using term insurance. As a general rule, term insurance should only be considered to be temporary insurance, to be used for risks that will end before the life insured reaches 60 or 70 years of age. If the risk will extend until life expectancy, some form of permanent insurance should be considered. This section provides some examples of when term insurance might be appropriate. This section provides some examples of when term insurance might be appropriate. 2.8.1 Short-term risks. Term insurance is particularly suited for short-term risks of known duration. If there is a possibility that the risk could extend beyond the anticipated duration, the policyholder should choose a renewable policy. Life Insurance Chapter 2 Term Life Insurance 24. Example. As the owner of a new business, Felix was able to get a $100,000 loan from a private investor. The loan is interest only for 5 years, when it is payable in full. As a condition of the loan, Felix is required to obtain life insurance with a minimum death benefit of $100,000, with the lender named as the beneficiary. A $100,000 5-year term insurance policy would be the most cost-effective option for Felix, and it is ideal for covering a 5-year risk. 2.8.2 Decreasing risks. Decreasing term insurance may be well suited for covering risks that diminish over time, such as mortgages or other loans that are repaid over a known amortization period. Examples of other risks that diminish over time are given below. Example 1. Mohammed left his position as vice president of ABC Limited at age 55, and he will receive a full pension starting at age 60. The pension will continue undiminished, payable to his spouse Helena, if he dies while receiving the pension. In the meantime, Mohammed is self-employed as a consultant, earning $100,000 per year, and he plans to retire at age 60, when his pension from ABC Limited starts. Because he no longer works for ABC Limited, he is no longer covered by their group life insurance plan. Mohammed wants to protect Helena from the loss of his income if he should die prior to retirement. Mohammed can purchase a 5-year, $500,000 decreasing term policy to address this risk. Example 2. When Rob and Gabriella divorced, the court ordered that Rob must provide Gabriella with child support of $50,000 per year until their twin boys finish university or reach age 23, whichever comes first. The boys are currently 13 years old. Rob can purchase a 10-year, $500,000 decreasing term policy to meet this obligation in the event of his death. 2.8.3 Limited cash flow. Perhaps one of the most common reasons people opt for term insurance over a permanent policy is that they simply do not have the cash flow to put towards a permanent policy. Angela and Doug are in their late 20s. They have been married for 3 years and just bought their first house. While they both have promising careers, they have just had their first child and Angela is home on maternity leave. With Angela's reduced income while on leave, together with a new mortgage, a car loan, and student loans, cash flow is very tight, and yet they realize that their young family needs life insurance protection. At this time, term insurance provides them with the most viable option. Because their finances are expected to improve over time, they should consider a convertible term policy, because it will give them the more affordable term insurance coverage now, while giving them the option of converting that to permanent coverage when their finances permit. Another reason some people opt for term insurance over permanent insurance is that they would rather use the difference in premiums for investment purposes, because otherwise they would not have enough free cash flow to contribute to their Registered Retirement Savings Plan, or RSP, Tax-Free Saving Account, TFSA, Registered Education Savings Plan, RESP, etc. This approach of buy term and invest the difference can certainly build wealth over time, provided that the policyholder is disciplined enough to actually make those investments, and that those investments actually perform well over time. Chapter 3, Whole Life and Term, 100 Insurance. Competency component black small square analyze the available products that meet the client's needs. Competency subcomponent black small square analyze the types of contracts that meet the client's needs. Life Insurance Chapter 3 Whole Life and Term, 100 Insurance 27.